Hey everyone, welcome back to Ceylon Smart Finance. Today, I've got a fun little story for you about the difference between bonds and stocks. Our main characters are Tom and Jack, who bump into each other at the park. Let's check out their story.
Hey Tom, long time no see. How have you been?
Hey Jack, I've been trying to learn about investing lately, but I'm a bit confused about the difference between bonds and stocks. Can you help me out?
Sure thing. So, bonds are like IOUs. When you lend money to a company or the government, they give you a bond, which is basically a promise to pay you back with interest on a specific date. In simple terms, you're the lender and they're the borrower.
So, the returns from bonds mainly come from the interest, right?
Exactly. Bonds pay you regular interest, which is set in advance, making them a lower risk investment. For example, if you buy a government bond, the government will pay you interest every year until the bond matures.
I heard that bonds are related to interest rates. Is that true?
Yes, bond prices and market interest rates are closely related. When market interest rates go up, new bonds offer higher interest rates, making old bonds less attractive, so their prices drop. On the flip side, when market interest rates go down, old bonds with higher interest rates become more valuable.
So, if I buy a bond, will changes in interest rates affect my investment returns?
That's right. If you hold the bond to maturity, interest rate changes won't affect the interest payments or the principal you'll get back. But if you sell the bond before it matures, the bond's market price will be affected by interest rate changes, impacting your return. Now, let's talk about stocks. Stocks represent ownership in a company. When you buy a company's stock, you become a shareholder, meaning you own a part of the company. The company's profits and losses directly affect the value of your investment.
It sounds like stocks are riskier.
They are. Stocks are riskier than bonds because a company's performance can be unpredictable, causing stock prices to fluctuate. But the potential returns are also higher. If the company does well, your investment can grow significantly. Plus, some stocks pay dividends, which are a share of the company's profits. To sum it up, bonds are like lending money to someone. They pay you back with regular interest and eventually return your principal. Stocks, on the other hand, mean owning a piece of a company. If the company makes money, you make money. If it loses money, you do too.
Thanks, Jack. Now I get it. Bonds are better for those looking for steady income, while stocks are for those willing to take more risk for higher returns.
Exactly. When investing, you need to choose the right tools based on your risk tolerance and financial goals. You can consider a mix of bonds and stocks to balance risk and return.
That sounds like a great idea. Thanks a lot. I feel much clearer about investing now.
You're welcome. Investing is a continuous learning process. If you have more questions, just let me know.
Let's grab a coffee at that cafe. I have a few more questions to ask you.
I hope you all enjoyed today's story and now understand the basics of bonds and stocks. Investing doesn't have to be complicated as long as you're willing to learn. Don't forget to like, subscribe, and share this video. See you next time.